Welcome, everybody, and thank you for joining us on this first webinar in White & Case's Capital Markets ESG Week with the theme of Accelerating the Sustainability Transition. This session today is on the topic of sustainability-linked bonds and will include an issuer's insight. Tomorrow, we have two sessions, one in the morning on ESG disclosure in the context of an IPO. Tomorrow afternoon, we have an exciting panel lined up to discuss the convergence of ESG and CLOs. We come back to revisit sustainability-linked bonds on Wednesday afternoon with a distinguished panel, this time specifically in the securitization and covered bonds context. Then on Thursday, we have two further webinars. In the morning, exploring how Islamic finance can accommodate ESG. And our final session on Thursday afternoon will include 5 experienced speakers taking questions on the opportunities and challenges in scaling voluntary carbon markets. We hope you can join us throughout this week, and it's my pleasure to now hand you over to Sean Jin, our moderator for today's webinar.
Thanks very much, Richard, and hello, everyone. Thank you for joining us. I'm Sean Jin at White & Case in Hong Kong. It's my pleasure to welcome you all and also to be joined by a globe-trotting or rather globe-spanning panel of expert speakers who are from H&M, Carl Gemsel, Group Treasurer, and Lisa Spetz in Treasury as well, who particularly focuses on sustainability. I'm also joined by my colleagues at White & Case, spanning the world, capital market specialists and partners, Richard Pogrell and Debashish Day, who are in London and Dubai respectively, and I'm also joined by Michael Bark-Jones in Stockholm and Pietro Maniaghi in Milan. Before we kick off proceedings, I should mention that the portal through which you're viewing this webinar presentation today, you're able to provide and send questions live, which we'll address at the Q&A at the end of the session. Now, as Richard mentioned, this is the first of a series of webinars that we're hosting during the course of this week. So with this particular webinar, we kind of really wanted to set the scene for what's to come ahead, and we thought there's no better way to set the scene and get an issuer's insights as to how sustainability-linked bond transaction is set up and how it works. We'll also be looking at, in addition to what it takes to put together a sustainability-linked bond transaction, kind of the risks, the trials, the tribulations through kind of real-world experience as to what these transactions involve and what considerations stakeholders have to bear in mind. And then we'll wrap up briefly on where we see the market is going, what trends we see, and what's on the horizon. So without further ado, I will hand over to Carl and Lisa to introduce themselves and also their transaction. Over to you, Carl and Lisa.
Thank you. Thank you, White & Case team, for inviting us to this event. Very nice to be here. My name is Carl Gemsel. I'm the Group Treasurer at H&M, and with me I have Lisa, who's worked within Treasury with focus on sustainability. You can flip slide. And today we will share our experiences from our debut sustainability-linked bond that we launched in February this year. We will start with a brief introduction to our transaction, and then we will move into our sustainability work and the process around our SLB framework. Next slide. One more. So, as already mentioned, this was our debut bond transaction. And I believe since it was our debut and that we also made it sustainability linked, it caught a lot of investor and media attention. And as you can see on this timeline, it took almost 1 year from start to completion of this sustainability-linked transaction. And for us, we started with this process from not having any capital market experience at all, and we worked us through various steps. We started drafting documentation, of course, an EMTN program. We choose an EMTN instead of a local MTN program in order to get access to euro and the liquidity that the euro market provides. And with the EMTN program, we found it beneficial also to establish a finance BV to become CSPP eligible. Then we also start drafting a green framework. This itself took around 6 months. And another thing we needed to do is to start engaging with rating agencies in order to obtain a public investment grade rating. And of course, we also needed to start prepare investor meetings. This was all new to us, and also the reason why it took a little longer maybe than what we expected. But although it took some time to get everything in place, I must say it was a very efficient project and a case of great collaborations between internal H&M functions together with external advisors such as White & Case, but also many of our core relationship banks. Many functions within H&M shipped in: Treasury, sustainability, controlling, investor relations, press, legal, and also which was very crucial for this transaction was great sponsorship from senior management. For us, it was an easy choice to make our debut bond a sustainable, since sustainability is really embedded in our culture and strategy, and linking financing with strategy is something we really wanted to do. But to choose this format, the SLB, was not clear from the beginning, and that became more evident during the process. And Lisa will now give a little more information on that part. Next slide.
Yeah, next slide. So H&M Group has set out the goal to become climate positive and later than 2040 across our entire value chain. Next slide. So what does that mean? Here you see our climate footprint over our value chain, from raw materials on the left to customer use on the right. And understanding where our emissions take place is key for us to be able to achieve the goal that I just mentioned. Since, as you can see here, in the red staple, emissions from our own operations, our stores and offices around the world, they stand for less than 1% of our value chain emissions. We should be climate neutral in our own operations as well, but the main impact will come from investments in our suppliers' factories and their suppliers' factories, so our scope 3, as well as raising customer awareness. So this is also one of the reasons why we chose to do a sustainability bond rather than a green or sustainable bond. Next slide. So climate neutrality, it's a key success factor for us in the long run, and there are lots of business opportunities in this field, but many investments that need to be made now are costly. And we need to secure that our climate goals do not conflict with our normal business goals. Therefore, we have created a green investment team under the group controlling department, and they have their own separate budget for green investments, and their performance is measured on emission reductions that they achieve before economic return. So funds from this budget can be allocated to central investments in, for example, solar, new technologies, but also to make funding available when there are projects within the business for which there is no room in the department's own budgets. We need to do things differently and find new ways of working, and we are looking at new materials, new techniques, new business models, but also internal carbon pricing, new financial solutions, and partnerships with peers, banks, and investors. Next slide.
We at Treasury also really would like to be a part of this, and collaboration between functions is a key success factor. And we as Treasury representatives have a very important function to play, I think. not just as a support, but to be part of the work from setting up strategy and goals and implementing projects. Treasury now has one person working full-time with sustainability, ensuring that all topics we're responsible for are dealt with, such as financing, calculating business case, financial risk management, but also legal and tax and accounting. And this is a recommendation from us to other Treasury departments to have that focus. And we believe it's key to make progress and lead the change. Next slide.
So now take a look at the sustainability-linked bond framework. Next slide. So an SLB consists of 5 components. First, choice of KPIs. What should we measure? They should be relevant and impactful from a sustainability point of view. Next part is sustainability performance targets, SPTs, meaning the goals we set for each KPI by a certain date. Then we have bond characteristics, meaning what happens if we fail to reach one or several of the SPTs, and when and how that is triggered. Reporting, you have to report annually on the KPIs in a bond progress report. And finally, verification. The performance on the KPIs should be verified by an independent third party on an annual basis as well. We also chose to have a second party opinion on our framework, where an independent party comment on the level of ambition of the goals in the framework. That part is voluntary, but we felt that it would add value both for ourselves, but also to add credibility towards investors. So then taking a quick look at what our bond framework looks like, our first KPI is to increase the use of recycled materials in commercial goods with an SPT of 30% by 2025. And this is something that will show a quite quick return in form of reduced emissions. So thanks to great collaboration between our different buying organizations, we managed to set this ambitious goal of 30% recycled materials already 2025. And here, I need to remind you that this is an industry where recycling has been at very low levels or even non-existing only a few years ago. So we consider this to be, as of today at least, the most ambitious goal for textile material in our industry. So our second KPI is to reduce our scope 1 and 2 emissions with an SPT of 20% by 2025 from a 2017 baseline. When setting our SPTs, we looked at other companies and saw that they were much focused on own operation for scope 1 and 2. But for us and the majority of our industry, this doesn't make sense since, as you saw in a previous slide, own operation is responsible for less than 1% of our value chain emissions. So from an impact perspective, scope 1 and 2 is minimal, but it's symbolically important. So we include that. But our third KPI is to reduce our scope 3 emissions with an SPT of 10% by 2025. And our scope 3 emissions, as you saw, that is what will really create change. And to reflect the relative importance of each KPI, we have assigned weights to each SPT of 40, 20, and 40% respectively of the step up on the coupon if we fail. And this is to highlight what is most important from a climate change perspective and to avoid any greenwashing discussions. Next slide. So Sustainalytics have then given us a second party opinion on the framework. They are of the opinion that the framework aligns with sustainability linked bonds principles. The KPIs are relevant and material, and the SPTs are ambitious and impactful. And our SPT1, the recycling goal, is regarded as highly ambitious, representing leadership in the clothing industry. That's all for our presentation. Over to Sean.
Thank you very much. That was incredibly insightful presentation from the two of you. You also mentioned a few things which we're going to try to cover in the half an hour that we have left in this panel discussion. They are bond characteristics, reporting / verification, and also greenwashing. So we'll try to tackle each of those. I think that's a key when considering structuring these kinds of transactions. Before I do, though, or kind of as a segue into that, perhaps I could turn to you, Michael, who kind of, you were on the other side of the coin, working on the same transaction. As someone who's worked on plenty of conventional bonds as well as or green bonds, how did you find the experience to differ, or what kind of considerations, what additional work streams did you consider had to be essentially had to be undertaken or had to be factored in? And how did what did H&M do right in terms of their preparation to launch a successful deal?
Thanks, John. Yeah, so I think what did they do right? Let's start with that. I mean, I think, as you heard, the team were incredibly prepared and willing to take the time to do it right. And I think that is absolutely key for a sustainability-linked bond that's still relatively early in their development, and it takes time. The framework takes time. Aligning the framework with the terms and conditions of the bonds takes time, however much time you spent on the framework. And for lawyers to understand how the sustainability side works and the Treasury side works, and then translate it into terms and conditions, and then to feed back as to how those elements will impact the company over the long life of the bond. This is an 8-year bond. So it was really important that we didn't include certain factors that just wouldn't work for H&M. And so despite the long preparation, we had at least three weeks or 4 weeks, I think, to implement the framework into the terms and conditions. We still had extensive discussions with SLB, the sustainability advisor, with the H&M team, not just Treasury, but also on the sustainability side and management side as well. So it was a really, really interesting process, but very different to any conventional bond. You normally wouldn't talk to all of those parties at all. And obviously, the key points around there are the triggers. What is going to trigger the step up in the coupon? When the timing, so when will that actually impact the coupon? Very important point as well. And reporting. And reporting actually was surprisingly difficult, because obviously the time when the year, for example, in recycling, I think ended in October, whereas the year for scope 1 and 2 was the end of December. So you had to really align the terms and conditions to allow for that disparity in time periods, which was very interesting. And particularly on reporting, where you had the scope 3, which was a very new KPI, I think, at the time, and probably still is, and difficult to measure given all those external factors. And I think, that led to a question over whether or not reporting should trigger an event of default, for example, as a failure to report usually would. But here, there was, they had never reported under these FPTs before. So it was a very important point for H&M to make sure that they couldn't trigger a cross default there just by failing to obtain the right verifier, or for a verifier to actually be able to verify. So I don't know, but Carl or Lisa, maybe, do you want to just discuss how you found a verifier who could actually verify your scope 3 and what the challenges there were? Because I know there was considerable discussions.
Yeah, as you mentioned, so it doesn't trigger, if we fail to report, it doesn't trigger a default, but it does trigger a step up. So already year 1, we have to be able to report, and we have to get it verified. So it was very important for us to know who would be the verifier, and also given the data that we expect to have, that will be sufficient for the verifier to be able to give a limited assurance. So we had worked with Deloitte, who is our new auditor, and they got to look at this and could confirm that they would give their assurance, and given the data that we expect to have, they should be able to give a limited assurance.
Right. Can I just jump in and touch on that point? Because obviously reporting and SPTs, they kind of go hand in hand. You can't really have one without the other, or one somewhat meaningless without a way to to check. An SPT doesn't really have much value if you don't know how it's actually performed and how to check it. Can I turn to you first, Debashish, and then Richard, I'll come to you with a follow-on question. But Debashish, can I first ask you as to, from a legal perspective, or even just from a commercial perspective, why is reporting and the frequency of reporting so important for these kinds of transactions?
Thank you, Sean. I mean, it's interesting. Michael and Carl and Lisa sort of touched on this, haven't they? Because the complexity here in this space really relates to what are we reporting on, and when is that information available to report? And that is the difficulty on the Treasury side. But the difficulty on the investor side is the investor wants transparency on when the step up might be triggered. And remember, investors are trading these instruments as well. And so the pricing metrics of these instruments will fluctuate or move based on the availability of that data. So I think actually as sustainability-linked bonds evolve, it's going to be incredibly important to try and get more frequent reporting, because traders really, really will want to understand if that step-up coupon is coming soon and whether the data that they're receiving is accurate. So let's take a very, very simple example in terms of time lag. If we're talking about achieving, for example, a target, and I'm not going to pick on H&M, but we could even use something like waste manufacturing, and we're talking about in, say, a automotive company, which is talking about the number of recycled parts going into its vehicle production line. The question is it talking about last year when it's talking about data? Is it talking about quarterly? And that is still a question that's still being debated. And I think it will drive commercially how well deals are received. I think as this evolves, the more frequent reporting, the more likely that the bond may have a better reception in the market. We're still at early days of that, Sean, but I think that's where I see it going. Back to you.
Thanks very much, Debashish. I want to just segue from a point there, because I think that certainly in my experience and just across the full spectrum of sustainable products, not just sustainability linked, but the use of proceeds products as well, and just ESG in general. I think what I see, and I think what probably many of us would agree we see, is that there's a real drive for transparency. It's really kind of an efficiency story whereby we're connecting capital with sources of capital by facilitating information flow. And arguably for a sustainability-linked transaction where, again, arguably there's perhaps actual kind of more bites than a use of proceeds green bond, for instance, because there are consequences. Michael mentioned the ratchets that we have on sustainability-linked bond transactions, which I just want to explore now with Richard. So in terms of what you've seen, could you just provide a kind of just an overview of the types of kind of permutations you've seen in sustainability-linked bonds where, for instance, one SPT, sustainable performance target, is not met, or multiple are not met, or where reporting obligations are not complied with? Right? What are the consequences of those kind of failures?
Sure. I think this is a key point, Sean, and I think it's not entirely understood either in the market. And in the very early stages of certainly in sustainability-linked bonds, we had these discussions, and particularly amongst lawyers and everyone on the deal teams, about what should be the consequences and for which aspect of either the targets not being met, reporting, and good faith and bad faith, and should there be different consequences and so on. But if we take a step back for a moment, what the ESG products and ESG finance products are trying to do is really move the market in a direction, and yes, that in a way trying to reward good performance and ambitious and deliverable performance, and then that being actually delivered in due course. But they're not necessarily out to trip up issuers, borrowers. There's no intention here that a good faith issuer who is spending its time coming out with the targets and doing everything it thinks is right now in what are effectively medium to longer term instruments, particularly in sustainability-linked bonds. And then if there is an issue later on, that should somehow cross default or cause a major financing incident of the issuer. that's not really the intention. And so with respect to the answer to your question on events of default, I mean, we just don't have those. They're not there in any of the instruments. You won't see them for missing any of the targets, missing all of the targets if it's multiple targets, or indeed in either failure to report or get verification. So these are all important deliverables, important metrics and thresholds, but the consequences will always be whatever the maximum consequence will be, the financial consequence or structural consequence that's built into the terms and conditions, and that's going to be, coupon step up, which could be in multiple phases, could be, you could have the different scope emissions targets, you could have other targets as well, like H&M's case, quite a complex mix with different step-ups and ratchets which could apply in different scenarios. But the worst case scenario is going to be the maximum step-up. It's not the case that we have these sort of dire consequences delivering on the issuers if they fail in good faith to effectively deliver or find a verifier or obtain verification, etc. Over to you, Sean.
Thanks, Richard. Yeah, it's very it's quite interesting. I find, and it's obviously very, very important and core to how these transactions are structured and set up. That SPTs have to be they have to be developed in a meaningful way, and they have to be targets that are, we all say, ambitious. But it's not always easy to develop SPTs. It's not always it's not always something that you can just come up with overnight. As we've heard from the H&M team, it was quite a very involved process to set up a framework and to tie that framework eventually to essentially contractual ratchets and terms and conditions, and to integrate that framework into a financial transaction. I think one of the things we often find as well is that SPTs are bespoke and industry specific as well as issuer specific. But even when you're looking at SPTs that are industry or issuer specific, there may be, I think in our experience, unforeseen consequences or things that you can't necessarily predict that may affect how an SPT is defined. And I think, Pietro, we were discussing recently quite an interesting anecdote on a real-world transaction that you had worked on where there was SPTs being set, but unforeseen kind of non-controllable kind of third-party variables that affected how we actually calibrated those SPTs, which became important. Could you share that experience?
Sean, so I have to say that actually the interplay and combination of different KPIs is indeed an additional layer of complexity for SLB issuances, and I mean this is perhaps a bit exacerbated by the fact that while you're still working on legal documentation, the structure is subject to change. Also considering the additional thinking on the structure and on these potential future events that may somehow tilt the balance of the overall SLB deal originally thought and agreed between the issuer and its advisors. And I mean, this complexity perhaps is a factor that arises from the need to achieve a fine balance between ambitious targets on one end and being in a position to realistically achieve these targets in the future on the other. And getting to the Aeroporti di Roma issuance, the additional complexity was that the KPIs that were thought were not only on the reduction of CO2 from sources that the issuer could control or somehow easily control, but also sources coming outside of the organization on which the leverage of the issuer is at best indirect and at worst minimal, and this is the Scope 3 CO2 targets that also H&M used in their SLB issuance. And I mean, all these expose the issuers to the risks of not being able to reach the target, not only because of default, but because unexpected events or even events that may be predictable but have a very significant effect on the targets that the issuer is taking occur in the future. And this is even more felt as long as we have medium to long-term instruments. And I mean, to get a little bit deeper beyond the example of Aeroporti Roma, there's been a lot of thinking about what kind of events may have a negative effect, a negative impact on the possibility to reach a target. And this kind of exercise is perhaps something new for all the issues, because perhaps everybody is used to think in terms of credit impact of future events, but the assessment of future events as to ESG impact is completely different. And one example for this was in ADR, because I mean, as an example, there are several jurisdictions that are considering adding a ban or a limit to short flights, short-range flights. And from the perspective of an airport such Rome, this could have positive implications in terms of P&L and in general from a credit perspective. But from a CO2 calculation perspective, that is not necessarily good. Actually, it's most probably negative impact, because it would somehow enlarge its catchment area, and so you have a lot of more passengers coming from far away, taking their cars to get to the airport. And so what do you do when you identify these potential material events that somehow changes the structure of the deal? And so we're seeing there is a very, very focused attention on how do you rebalance in the future your targets to take into account this kind of extraordinary events. And from this perspective,
can I just pick up on one point, actually, and we might come back to that, Pietro. But I think what's very interesting is, the concept of unforeseen risk. Or, I mean, ultimately, we, the lawyers on the panel, our business is mitigating risk and building in protections against risk. And there are all sorts of risks that arise in any kind of transaction, but particularly where we're kind of at the cutting edge of the sword and developing new transactions. And for instance, the Rome Airport example is one example of how you might think to. I think essentially what you were saying was structure a transaction to take into certain KPIs and certain SPTs, but because someone built a motorway next to the airport, that increases car traffic and greenhouse gas emissions, and it may be completely not within the control of the issuer, in this case Rome Airport itself. How do you factor that in? Before I go into further on that, and I'll expand that kind of to the whole panel to discuss, because it is a core part of structuring these transactions. I want to come back to the H&M team, because I want to ask them from an issuer's perspective. There's all sorts of risks that you've got to consider. There's commercial risk, there's an actual ESG risk itself is a risk in its own right. There's legal risk, and there's reputational risk as well. From your perspective, when you were going through the process, Carl and Lisa, deciding what kind of funding platform you would use and whether it would be green, sustainable, or sustainability linked, what was your kind of greatest kind of priority in terms of, or what were you most conscious of from a risk perspective?
Maybe I can start. I think you're right. Yeah, many risks, but I think from our perspective, and choose the SLB and the KPIs, I think the actual coupon step up of the risk of failing is maybe not what's what we are most concerned of. But of course, not achieving the reputational part, as you mentioned, is something we, of course, want to. It's a risk that's there, and it means also, since we choose the scope 3, which could have some reporting and verification problems, that is an extra risk that we have on our SLB bond. I don't know if you have any.
Okay. Well, I think that's quite it's quite interesting to see that notwithstanding you've gone on the path of a transaction which gives you risk and reward through performing or failing to meet SPT, the commercial aspect of that, the economic outcome, was just as the reputational outcome was just as important, if not more important, than the economic outcome, which really shows what your priorities lay. I've opened this to the H&M team as well, but maybe I can actually go back to Debashish and also Michael, who works on the transaction. From a legal perspective, how do you see these kinds of risks being mitigated? So maybe Michael, I could go to you first. And what kind of things did you have to build into your transaction, for instance, risk factors?
Yeah, absolutely. And actually, the scope 3 was an interesting one in the framework itself, as well as the terms and conditions. There's a factor whereby the current reporting under scope 3, or the current at the time that we put the bond into place, at least, was not particularly strong. I think it would be, let's say, or not particularly developed, perhaps as well. And the company was working on its methods of developing that. And so obviously there was a danger that actually once they developed it, the goals could differ. And so there is a mechanism in the framework which basically refers to that potentially better reporting, so to speak, or more granular reporting. Equally, another risk, of course, is if for example, M&A activity would happen during the life of the bond. No one can really say. And if, for example, H&M were to buy or dispose of a company in that time, obviously the baseline would effectively change. So there's also another feature whereby if an event is seen to have, I think it was 5% impact, then the baseline could be amended. It would have to be verified by the external verifier to give it credibility again. But so there is an element of protection there that it will move as the company evolves. I don't know, Carl or Lisa, if you want to comment at all on that.
No, that's correct, because especially the scope 3 data reporting, that is a challenge for us and for, I would say, everyone in our sector. But we're putting a lot of effort in trying to gather as good data as possible. That being said, the scope 3 data that we report our first year is not going to be perfect, but I think the key is that we use the best available data and that we continue to work on trying to get better and better data each year.
Yeah. Thanks very much for that. I think I'm just conscious of time, so I just want to move on and maybe wrap things up with just a few other topics that I think will be useful to discuss. One of them, kind of just on the topic of risks and risk mitigation as well. But we've discussed a fair bit from the issuer perspective. I wonder if I could turn to one of Richard or Debashish. Maybe Richard, maybe you want to start and discuss what are the things that managers or arrangers, underwriters of transactions, who I'm sure we have in the audience here, should consider as well. Is greenwashing still kind of the main thing as well?
Greenwashing, yeah. I mean, it's everyone's favourite topic. We're all terrified of giving press interviews, right? Because that's the first word that comes in. I think it's fairly established now what the role of arrangers, underwriters, managers are in transactions, and I'm talking only in non-US offerings here, because there is a whole market development when we're looking at US offerings, which is potentially going to influence things a bit. But But there's no expectation that the managers are fully sort of verifying or diligencing necessarily every aspect here. This is an issuer's strategy, it's an issuer's medium and longer term sustainability strategy. I think what's important is the transparency, the disclosure, the reporting. That's something everybody is focused on, and that's the way the market needs to move. But in terms of the actual underlying, when you get into the nitty gritty of baselines, historical figures to back up those baselines to which SLBs have the performance targets linked to on the KPIs. I don't think there's any expectation that arrangers are really getting into the gritty or need to or should get into the gritty on that and to verify. And there are external third parties here who are environmental consultants and experts who are doing a lot of that. Obviously, in the documentation, we see masses of risk factors and disclosure and disclaimers around this. That's sort of legalese, but I think there is a legitimate understanding in the market of what the appropriate role is, and what the transfer of risk should be.
Thanks, Richard. That's very. I think that's a pertinent point, which is obviously there is a market developing, and there are certain customs and standards developing, but it is still a developing market. And kind of on that, in that vein, if I could just finish off, Debashish, with you, I just looking ahead, what does the future hold? What trends are we seeing? I mean, certainly for me, sitting in Asia at the moment, it's quite interesting to see how the market in Asia is kind of essentially tracing what we've seen in EMEA over the last few years and really building up ahead of steam. What's also particularly interesting, actually, is in the sustainability linked space. Loans seem to be kind of growing at a slightly faster pace by volume, if not by value, versus bonds. Do you see similar trends, Debashish? And could you elaborate on why that might be the case?
Yeah, I think I do see similar trends. So at least if you turn your lens to the Middle East and emerging markets, these markets are often dominated by state-owned or state majority-controlled resource sector type industries. So, and those are often industries that are in what we call the more brown end of the spectrum in terms of polluting or carbon emissions, et cetera. And I think while the challenge of something which was a green loan or a green bond was tough for these industries to work out what they're supposed to do with the use of proceeds, and also accusations of perhaps greenwashing, sustainability linked has actually been an area they've moved into much more successfully, because it's much easier for them to explain, particularly with energy transition and so on, what targets they might have, and in particular for those companies to set targets that fit a little bit better alongside regional aspirations. So it may not be perfect for everybody in the world, but at least in a region that's trying to improve, and particularly in emerging markets, they can set goals and targets that make sense in their industry. And I think where we're seeing that development is first in the loan space, where a lot of these companies have traditionally raised their funding from, and they've managed to work out that this is where they can first test out those targets and those measures, because it's being done in a much less public forum, but still with an intelligent group of lenders. And therefore, this is where we see the evolution, first in a more private market. Back to you, Sean.
Thanks, Debashish. I think we're coming to the end of the session now. We have 1 minute left. Maybe we can stretch that to 2. We have a couple of questions from the audience, so I just want to give the audience an opportunity to feedback. So the first one is, I'll read it out. Was any methodology applied, and this is to the floor, but maybe to the H&M team, was any methodology applied in economic estimations of the magnitude of the coupon step up in respect of KPIs and sustainability performance targets? That's to the whole panel. Have you seen any that kind of measurement?
Not really. Was not the size of the coupon step up. Wasn't really. It was a standard, and it was not really discussed. It was kind of that's where it is. That's where the market is, and that's how we went about it.
So it's not really there's not much linkage in a way in terms of the commercially accepted versus the actual KPIs, which are separately. Okay.
Yeah. So we had this 25 basis points. Sorry. We have 25 basis points per year. So that was in line with market practice. And then we have the allocation base, the different weights for the different KPIs to show the relative importance.
Okay. Thank you. Thanks very much. And then the final question is to the lawyers in the room. How do you see the kind of regulatory developments impacting the growth of the sustainability linked bond market in terms of the increasing requirements for disclosures generally amongst financial markets? It's open to the floor.
Yeah, Sean, maybe I can take that one. It's Richard here. I think they're going to have quite a significant impact, both in terms of the overall amount of reporting we're going to see and that increase. So that's obviously going to have a huge impact for the whole market. It's going to increase confidence. It's also going to mean companies are reporting a lot more information, and that means it's just a lot easier for these for standardization really to occur, and that's going to help everyone in the market, including investors in particular. I think also things like the European Green Bond Regulation, even though it doesn't apply to sustainability linked, that is going to have an impact on all of the ESG market, assuming that comes in, it's in its form. Things like the rules that would be implemented regarding third-party verification and assurance is going to have an impact on the sustainability linked market as well, hopefully in a good way, and provide further impetus. Over to you.
Thanks very much, Richard. With that, I think we're out of time. So first of all, I'd like to thank our panelists, in particular, the Carl and Lisa from H&M, and I would like to thank the audience for your time today. We do hope that you join us in our other sessions coming up this week. Thank you again, and goodbye.
Thanks, Sean.